Good morning, everyone. Good morning. Good morning. Good morning. So today, let us take a topic from your third unit, and this is ratio. Ratio. And first of all, let us try to understand what is the meaning of ratio. What is the meaning of ratio? Let's go by that. Syllabus wise, what is the meaning of ratio? We should first understand what is the meaning of ratio. After that, we shall go for other items. Meaning of ratio. So see, ratio actually means the relationship between two or more figures. Very simple. Ratio, you can say it's a relationship between two and more figures. It is given a simple arithmetical expression of relationship of one number with another. Ratio is actually nothing but a simple arithmetical expression of the relation between two numbers. It may be more than that also. That is a ratio. Simple relation between two. According to Gour, a ratio is relation of the amount A to another B, expressed as a ratio of B is to 1 or A is to 1. So we generally write ratio like this, or we write ratio like this. This type of we write ratio. This sign is given for writing the ratio. But as you know, it can be also expressed in percentage. Suppose 20%. 20% means 20 is to 100. It means 1 is to 5. Or it means 1 by 5. It's all the same. It's fraction. It's a ratio as a percentage. It means all the same. In every case, there is a relation between two figures. So when you go for financial statement analysis, you do not depend on one particular figure. I told you that day. One particular figure, if you consider, then your decision may be wrong. That day, you remember I gave an example that A company, A limited company, B limited company, two companies are there. And A limited company, suppose A limited company's profit is 5 lakh, suppose, and B limited company profit is suppose 2 lakh. I gave this example and I asked you which company share you are going to purchase. And most of you said that A, because A is having more profit, and since you are a student of commerce, you understood that if profit is more, dividend will be more. Very simple, you thought that way. You also, your intelligence convinced you to think that if profit is more, goodwill will be more. And many things you can write a lot of theories about that when profit is more, what happens. And you are true. But then, this is a figure taken from financial statement and single figure. And if you consider this only, there may be problem, and how it problem will be, I am showing you. Next you take, suppose A limited 5 lakh, for 5 lakh A limited, their capital was 50 lakh. So you are connecting with another figure. And B limited profit is 2 lakh and its capital was 5 lakh. Now you think what is going to happen? In case of A limited, what is the profit? 10%? Is not it? 10%, because 5 lakh out of 50 lakh, 10%. And B limited profit will be 2 lakh out of 5 lakh. It is how much? Isn't it 40%? 40%. 2 lakh profit out of 5 lakh capital. See these two figures. A limited profit is 5 lakh. You thought is good, more profit. But the moment you connect with the other figure, say capital or the investment, you go for return on investment, popularly known as ROI. Or so its capital is 50 lakh. Out of 50 lakh, they are earning 5 lakh. And out of 5 lakh, they are earning 2 lakh. Now this connection is giving that A limited's profit is 10%. So if you invest 100 rupees in A limited, you can expect dividend 10 rupees in A limited. But in case of B limited, if you invest 100 rupees, you can expect 40 rupees. 40% return on investment. So that is the meaning of ratio. Ratio gives you the connection between two or more figures. Don't consider a particular figure itself. You create connection with other figures. So this is simply what is ratio. A financial ratio is a relationship between two accounting figures expressed mathematically. So when you come for financial accountancy, then we connect the figures between two mathematical figures, that relation, and we go to the depth, because I told you that financial statements do not give the absolute truth in all cases. Financial statements singly, if you take individually, it cannot give you the best result or best picture. So the moment you connect with other figures, you get the picture. And what is ratio analysis? Similarly, from the ratio, that was the mathematical expression, now you go for ratio analysis. Analysis, what is it? You analyze the financial statements through ratio. So when you go for ratio analysis, the technique of analysis and interpretation of financial statements is a process of identifying the strength and weakness of a fund by properly establishing the relationship between items of balance sheet and profit and loss account. So this is ratio analysis. The simple meaning of ratio, you have understood the relation between two figures or more figures. But ratio analysis, it means you are going for analysis of the financial statement by the help of ratio. So this is an example. I have only given you one example. This is ratio analysis. Analysis of what? Analysis of financial statements. By what? By ratio. How? By calculation. And what are the different types of ratio? There are different types of ratios we shall be discussing, because the two figures that you need for calculating a ratio minimum, you need two figures. Two figures you need minimum. So those two figures may come from PL account only, like relation between sale and gross profit ratio. Sale and net profit, both are coming from profit and loss account. Net profit ratio, you can take one figure from balance sheet, one figure from profit and loss account. That also can be done. You can take both the figures from balance sheet. In balance sheet you are having current asset. In balance sheet you are having current liabilities. Make a ratio. You know, current assets are those assets which are likely to be converted into cash within one financial year. You know it, current asset. You know the meaning. What is current asset? And similarly, current liabilities are those liabilities which are likely to be paid off within one financial year. Make a relation between those. Suppose current asset and current liability ratio, that also I told you, CA. Suppose CA is 5 lakh, and CL is 20 lakh. You can understand there is a problem, because you are having 5 lakh asset, current asset, and 20 lakh current liability. How can you pay? Maybe you are having fixed asset, lots of fixed asset you are having. Looking at the balance sheet, you are fine. When you look at the balance sheet, so much asset, fixed asset, too much of fixed asset, and you are happy. But the moment you connect between current asset and current liabilities, then you find the reality. If 5 lakh is current asset and 20 lakh is current liability, you can understand what will happen to you. You cannot pay your regular liabilities, expenses, electricity, wages, salary. You are having only 5 lakh, you have to pay 20 lakh. So the wage earners, your employees, and all other people may go for strike, may create problem because you cannot pay the money. So when you find out, and this it is known as technically insolvent. Technically insolvent. This is technically insolvent. You are having 5 lakh current asset and 20 lakh current liability. You are technically insolvent. Actually, we know that when assets are more than liabilities, we are solvent. Yes, you are having assets more than liabilities and you are solvent. But when you go for only current asset and only current liabilities, then you find that this is the position. You are having, suppose, one current asset and 20 current liability. You know, there's a problem. But at the same time, I must tell you, suppose the reverse is the case. 20 is the current asset and 1 is the current liability. Then you can think that this is good. Even this is not good. That they explained you, even this is not good. Why? Because this 20 current asset, 20 current asset and 1 current liability you are having. This is also not a good position. Why? Because you do not need so much of current asset. This could have been invested somewhere and you have not done it. So you are a bad financial manager. So when I want to invest in some company, I'll find the current asset and I'll find the current liability and I'll find the ratio. And that ratio is known as, current ratio. That ratio is known as current ratio. Current ratio, it's CA is to CL. This is current, or CA by CL. So this is the formula of current ratio. Now I gave you two pictures. Your current asset is 1 and current liability is 20. You say it, you understood. It's very bad position. You are convinced. But if I give a reverse case, your current asset is 20 and current liability is 1. You have seen the balance sheet of a company and this is the picture. You should not be satisfied. You should not be happy. You should feel bad with the management, financial management especially. Because you do not need so much of money in the current asset. This could have been invested somewhere and you have not done it. So company has not done it. And if you invest your money in this company, then your money also will not be properly utilized. You will get that idea. So the question is, as a research all over the world, exactly how much current asset we should have, how much current liability we should have. Is not exactly how much, but it is what is the ratio. The ratio will indicate. So internationally accepted standard ratio is 2:1. 2:1 is the standard ratio, you can say. This is the standard current ratio. If you are having 2:1, you can say that it's a very good company. It's a good company, 2:1. Because 2 is asset, 1 is liability. Even after paying 1 liability, you are still having 1 in hand, 1 rupee in hand. That is a good position. If it is more than that, bad, less than that, bad. So this is a standard. You remember that. We are going to calculate a lot of questions on current ratio. We are having those. But you just remember this is the standard. And this will help you to interpret a company. When a company balance sheet is given to you, go to MBA and other courses, balance sheets will be given to you. And balance sheet you should find the ratios and make comment. Simply mathematical calculation is not enough. You have to make comment. If you know that, if you have the idea that 20:1 current ratio is not good, only then you can answer it properly, make comment. If you are convinced that 2:1 is the ideal, and why it is ideal, if you understand that, then your comments will be right. So that's what I'm trying to convince you, that 2:1 is correct. And there are many more ratios. We shall be studying those. I have told you only one. For example, current ratio. We are having liquid ratio. We are having gross profit ratio. We have a net profit ratio. Profitability, debt equity ratio. Lots of ratios you are going to learn in the next class. Thank you.